Welcome back to Super Simple Spread Trades for Income. We're going to be talking about the super simple bearish butterfly here in part two. But before we get going, we would just like to remind you that this presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that the risk of loss in trading options can be substantial, and also that throughout this program, we are using hypothetical computer simulated trades that are believed to be as accurately represented as possible. However, live results may vary. In the last session, we were talking about the bull, and the bull is a fantastic trade. However, sometimes the market's overbought. And we want to be a little bit less bullish, or sometimes even, dare I say it, bearish. What do we do in that case? Well, some people, they go and they do this bull spread. If they're a little bit bearish, they'll put it on with a little bit lower delta, or instead of doing a 10 delta spread, they'll do a 5 delta spread. We've already shown in the last segment that that doesn't make a whole lot of difference on whether you're going to win or not if the market comes down fairly rapidly. How about a bear vertical? If I'm bearish, a lot of people, they'll do these bearishly positioned call verticals. The challenge with bearishly positioned call verticals is that they work great if you're correct. In other words, the market goes bearish and it goes bearish relatively quickly. However, they don't have a whole lot of room when the market moves up. So unlike a put spread that's bullish, you can take a significant down move against that put spread because you got so much credit for it, it usually works out. It's a little bit different when you do the call spread, especially if you do the call spread in an uptrending market when the volatility is low. You get less and less money for those calls that are above the money, and when you do sell a call spread, you get very little credit. That being the case, you have very little price movement that you can withstand against you before you run into trouble and lose that credit. So what I've come up with is something a little bit different, and it's called the bearish butterfly. For those of you who have taken the regular bearish butterfly program, you're going to find that this has a lot of similarities to that program. However, it's much, much more simple, and we're also adding a component of technical analysis to keep you out of trouble most of the time. And we're doing that by only entering the bearish butterfly when the market is overextended. Generally, this is designed to be used in place of a bearish vertical to take advantage of situations when the market's not likely to go much higher. And essentially, what the trade is it starts out as a bearishly positioned butterfly, and as the market moves, we increase our size in that position. And here's the general concept of the trade. The trade starts out approximately between 70 and 45 days to expiration. And it starts out by entering a third of our position as a butterfly with 50-point wings. The trade is entered negative delta with our short strikes between 20 and 30 points below the current market price. And then it's scaled into as the price goes up. And it follows the market while increasing position size. So if we were to take a look at this on an analyzed graph perspective, this is what an entry to a bearish butterfly would look like. We have our market price at around 645. We go in 20 to 30 points below the market, in this case at 620, and we put on a butterfly with 50-point wings. We're here, we're in negative delta. If the market drops from here, or even if it doesn't move, we make money, which is really cool, all the way down to this point here, 575, which is essentially going to be our exit point in the strategy. So if we're right and the market stays, or in this case doesn't go any higher, and just comes down, we simply make some money and we move on. If the market does not drop down, which essentially we would like the market, when we actually enter this trade, we would actually like the trade to go against us a little bit and get entered into a 2/3 position. If the market goes up and we're wrong, we add in, and now we have 2 butterflies. In this case, again, the market went up, we added a second butterfly. If the market comes down, we make our money. If the market continues to go up, we get fully scaled in. We go in 3/3. And again, we're waiting for the market to come down and for us to make our money in here. So essentially, that's what it looks like: 1/3 entered, 2/3 entered, and 3/3 entered. The trade should only be entered when there's a bearish bias due to the fact that the market is overextended. Once the position is entered, we will use the short or center strikes of the entry butterfly as a reference point to determine where we can take certain actions during the trade. So for example, if the Russell was at, say, 1,020, or say 1,025, we would enter our bearish butterfly with his short strikes at 1,000. So the Russell's at 1,025, the butterfly's entered with short strikes of 1,000. 1,000 would be our reference point. We're going to take that point and we're going to use that to determine when certain action is going to be taken. So essentially the trade is entered with a 1/3 of the position and then added to as the market rises approximately 20 points, and then added to again if the market rises another 20 points. If the market continues to rise past that, we get into this roll sequence until, of course, we hit our maximum loss number. So here is a general chart on how that might work. So when we enter the trade, we're going to enter with 1/3 of a position. When the market or the Russell hits our entry short strikes plus 40 points, we're going to add the second third. When the market hits the entry short strikes plus 60 points, our last third is entered. And then from there, every 10 points, we get a roll of our butterfly until we've hit finally our short strikes plus 90 points. We will roll our lowest butterfly 60 points, and we're going to hold or exit till our loss number. And that's essentially how that works. So in our last example, we entered with our short strikes at the Russell equals, when the Russell equals 1,000. If the Russell goes to 1,040, we're going to add our second third, or our second butterfly in, 20 points higher. If the market goes to 1,060, we're going to enter our last third. If the market goes to 1,070, we're going to take the lowest butterfly we put on. We're going to take that and bring that all the way up in front of our other butterflies. And if the market happens to go to 1,080, we're going to do the same thing again. We're going to take our lowest butterfly and roll it forward. And if it hits 1,090, we're going to do that again. So it's really very, very simple, and you'll see that once we show you some examples. So here is that shown graphically. In this case here, we entered with our short strikes at 460. That's our reference point. If we add 40 to our 460, that would put Russell at 500, which is right here. So when Russell is over 500, we're going to add our 480 butterfly, which is actually going to be added right here at 480. When the Russell goes over 520, we're going to add our 500 butterfly, which is going to be right about here. When the Russell hits 530 or is over 530, we're going to start our roll sequence where we're going to pick up this 460 butterfly and we're going to bring it all the way forward to the next strike that's 20 points higher than the last butterfly we had on. So before we go over any examples, I'm going to take the look at our risk plan. So the trades we're going to be looking at today are $5,000 planned capital trades. It's really the minimum size you can do this with. If you're going to do this, you should have a capital in your account of $7,500. And the reason is sometimes this trade goes over our planned capital numbers. Now there are ways to keep the trade within planned capital numbers, but that's a little bit more advanced, and we're just trying to keep things simple here. So you should have $7,500 in your account if you're going to do this. We're going to have a high profit target number of $1,500, a maximum loss of $1,500. As with the other trades, we make our decisions towards the end of the day. In our samples, we're going to be taking them at 3:30 p.m. Eastern Daylight Time or Standard Time, depending on the way the time's set in the U.S. here. The daily range tends to be ignored, unless of course a trade happens to be over profit target, in which case we will just take the money maybe intraday at that point. Again, these trades are done on the Russell 2000. As with the other trades, they can be adapted to other indices. You may need to do different strike widths, different scale-in points, and different add points from a technical analysis standpoint. But we're going to show our examples on the Russell 2000. So our trade exits. I'm going to exit if my profit target is reached of $1,500. I have a maximum loss number of $1,500. If that's exceeded at 3:30 p.m. or towards the end of the day. And really, it doesn't have to be 3:30 if you're trading this live. It can be 10 o'clock, 12 o'clock, or whatever it is you can check depending on your time zone and when you're actually available to check the market. The main concept behind this is you don't check the trade intraday and you don't pay attention to intraday ranges. We're making our decision points on one checkpoint during the day when we're leaving out the wide ranges that the the Russell 2000 can actually trade within during intraday levels. So this trade is also going to be exited 21 days to expiration. We're not bringing it any closer to expiration than that. If the price falls 50 points below the entry short strike, we're also going to exit. Or if our market bias for some reason has changed, would be another good reason to exit. In other words, you entered the trade and your bias was bearish, and for some reason something happened during the trade and you decided, well, I'm no longer bearish anymore. I think I'm going to leave. So I think those are all legitimate reasons to exit. For downside adjustments, if the trade's one-third entered, I'm going to close the trade when it's 50 points below my short strikes. So I put the trade on at RUT equals 1,000. I'm sorry, at RUT equals 1,020. My short strikes are at 1,000. If Russell hits 950, I'm out. Trade's over. If I'm 2/3 entered, I'm going to remove my upper butterflies if the price touches the tent to the downside. And again, we're going to show you examples of this. If I'm 3/3 entered, I'm going to remove my highest butterflies if the price touches the tent to the downside. So what we're going to use for technical analysis is we're going to use 45 to 75 days to expiration only when the criteria below are met. And for a normal entry, if Russell's been up at least 10% or 80 points, whichever is less, from the low of the last 60 days, and I have a bearish bias, that is what we would call a typical normal entry. If per chance Russell has been up at least 15% or 120 points, whichever is less, from the low of the last 60 days, that's what we would call a high probability entry. For the purpose of this segment, part 2 of the program, normal entry is all we're going to worry about. The reason I put the high probability entry in here is because when we do the bull versus bear in the next segment, we're going to use those high probability numbers to determine what type of trade we might be in at that point. So for this section, if we're up at least 10% or 80 points, whichever is less, from the last 60 days, and we have a bearish bias, then we're going to go ahead and do it. Realistically, if we're up 15% or 120 points in the last 60 days, that's a high probability entry. I don't have to have a bearish bias at that point, because if I don't have a bearish bias, there's something wrong with me. The market at that point is going, it may not come down, but historically, it always flattens out. So that would be a very high probability entry there. We don't see that too often. So I'm going to go over a sample trade that's going to go over scaling in and essentially scaling back out again. So here's the trade setup. It's June 5th, 2014. The Russell price is 1150.170. My low in the last 60 days is 1079. You might say that's not quite 80 points, and I would agree with you. If I had a bearish bias and I wasn't quite 80 points, I might be willing to enter the trade. Realistically, this trade was entered a little bit early. I purposely put flaws sometimes here in our examples so that we can point them out. So realistically, this should have been entered a little bit higher. The reason I entered it a little bit lower is because I wanted to hit all the trigger points for the upside in the trade example so that we can show that to you more effectively. So just realize that I should have waited a little bit longer for the price to get a little bit higher prior to entering this trade. But for the setup, this is what we did. We have entry strikes of 1130. So I purchased one 1080, 1130, 1180 put butterfly. Our reference point at that point is going to be 1130. If we add 40 points to 1130, that makes 1170, which is going to be our first add point. And that makes our last add point 1190. If the market goes to 1200, we're going to make a roll. If it goes to 1210, we're going to make a roll. If it goes to 1220, we're going to make a roll. Our initial exit point is going to be 1090. As the butterflies are rolled up, if that's needed, then our exit point will get to a higher price point here, of course our maximum loss is always also an exit point, as is 21 days to expiration. If we come look at our charts here, we can see we have our 60-day low. We take, we take the current price and we take a look at our 60-day low. And if the Russell's up over 80 points, boom, I'm good for entry. So here was actually the end of the day. And by the end of the day, the Russell was actually up 80 points, which is why it's written this way in the charts. So if I'm up 10% or 80 points, that's going to be my minimal entry criteria to meet. This is my very minimal entry criteria. Ideally, I would like it to be past my entry criteria. However, this would be minimal. For those skilled at technical analysis, ideal entry would be 30 points from a resistance level also. So for the program, this is the only entry criteria we're going to meet. Like I said, we're trying to keep some things simple. If we happen to be more skilled at technical analysis, then one of the things you can do is it would be very good if you're 30 points from a resistance level, because theoretically, if I'm 30 points from a resistance level, the market will go up enough for me to get 2/3 entered into my butterfly and then drop back down again. So that would be ideal. However, that's not necessary in order to be successful trading the system. So here I am. It's June 5th. I'm about 80 points up from my 60-day low. I'm going to come in here and I want to choose an expiration cycle. Now, one of the things is I want to make sure that I have enough time, right? It's imperative because I'm only going 21 days to expiration. And yes, the market's overextended. If it's a slam dunk that the market's coming down and there's just virtually, like if I was in a super high probability entry, I might be willing to take a close at expiration number. But in general, I'd say 95% of the time, I'm looking to buy more time for myself. So I'm usually going to go with a further from expiration number. So unless the market is extremely overextended, I like to have at least 55, 60 days. I would go with a 71-day expiration over a 43 expiration almost all the time. So that being the case, I come in here, the market's at around 1150. I come in with it's a little over 1150 actually, so I come in between 20 and 30 points under, which puts me at my 1130 short strikes. So here's a picture of the entry. I'm short 2 1130s, and I bought my wings 50 points higher and 50 points lower. This is what my entry graph looks like. The market goes up. If you remember, we had an add point of 1170 and an add point of 1190. If you're used to trading the regular bearish butterfly system that has delta theta ratios and stuff that you have to pay attention to, there's none of that in this. We're ignoring delta theta ratios. We're ignoring everything except for where the price is. And of course, we're paying attention to our maximum loss numbers. So here, by June 9th, the market's exceeded our add point of 1170. Now, one of the things to talk about here is you don't have to add when the market hits 1170 in the middle of the day, or if it just barely touches 1170. The idea here is if I'm going to buy this butterfly, I'd rather do it when the market is extended past 1170. The further the market goes past my add point, the cheaper I buy that butterfly. So and also, while the market's moving up extremely quickly, usually the cheaper I buy that butterfly. So like I said, I'm not sitting here in front of the computer waiting for it to touch 1170. Essentially, I come in, I look at my checkpoint, hey, I'm significantly over 1170. Let's add the second third of my position. So if that's the case, I go 20 points higher with my butterflies. My original butterflies are 1130. My new butterflies are at 1150. I do the same thing. I sell my 2 1150 short, buy my wings 50 points out. This is what my new position looks like. I sit in that position until June 30th. Finally, Russell has exceeded my add point of 1190. Again, I'm not overly interested in jumping in this the moment it hits 1190, but in this case here, it's towards the end of the day, near my checkpoint time. I'm certainly over 1190. I come in 20 points higher than my 1150 butterfly. I add my 1170 butterfly shorts, and I have my 50-point wing longs. So at this point, the trade's going to be drawn down. So here it's $284. Sometimes it might be drawn down a little more, sometimes it might be drawn down less. It kind of depends on the speed of the market at this point. But here's what my final position looks like. Now, if you remember, we have a $5,000 planned capital. In this case, I'm fully 3/3 entered. I'm only $3,600 capital in this thing. That is fairly normal. We buy our first third, we have a very small amount of money in the trade. We buy our second third, we have more. We buy our third third, we have even more. Usually that's still significantly under our $5,000 level. Remember with this, we're using a planned capital number of $5,000 and we want to make $1,500. We're not looking for, and that's a 30% gain by the way, but we're not looking for 30% on what we have invested. We're looking for 30% on our planned capital. So that's the way we're working with this. So even though we have like $3,500 in it, we're still using that $1,500 number for losses and for capital. So moving forward, usually, right, I want the market to stop there. If I go back on the slide, I want the market to stop here. This is as far as I would like the market to go. At this point, the ideal thing for me would be for me to actually be right in my bearish bias, right? Because you can see I was very wrong. I entered the trade and the market went up 40 points. That's wrong by a lot. That's not wrong by a little bit. So things didn't go my way. Had I done a bearish vertical here, I'd be gone. I mean, I'd be out of the market long before now. Right now, at this point, I still have the chance to make my money. So a reversal 2/3 in is really good because you can make some money. A reversal 3/3 in, it's not quite as good because now I've drawn down more maybe than I might want to because the trade's been going against me so far. But still, it's a really good opportunity to do things. If the market goes up 50 points over my original short strikes, then it's time to roll. And we roll a little bit earlier here because now we're trying to get more aggressive because the market, if you notice, we added in every 20 points. Now we're going to start rolling every 10 points. We're going to get more aggressive, more on top of the market because the market's not doing what we thought it was going to do, right? So this is kind of a fail-safe type of thing that's going to give you a chance to win if the market just kind of does that thing where a lot of times it comes up to a certain point and it just kind of runs sideways. This is going to give you a chance to win in that situation. So we come here, it's July 1st, Russell's exceeded our 1200 roll point. So what I'm going to do is I'm going to sell the original 1130 butterflies I put on. And I'm going to buy, I'm going to roll those up 60 points and buy 1190 butterflies. So now instead of being in 1130, 1150, 1170 butterflies, I'm going to be in 1150, 1170, 1190 butterflies. Here is what that position looks like. This is where the drawdowns start to get larger than what I might want, although we're still within our level. Remember, we had a $1,500 maximum loss level. We are getting up there. We're almost at 1,000. We're 886 for the loss. But the trade's essentially starting to go bad on us. But if the market movement is relatively slow, we can keep up this usually for quite some time. So here is our new position. If we go to July 16th, right, we hold that position till July 16th. The Russell, we didn't hit another add point, so the Russell never went over 1210, at least not at our checkpoint time. And we just held this position until now, right? So it's July 16th and the Russell backed off. Now our gain loss is up about 1245, which is getting near our profit target. If we take a look at what our analyzed graph looks like, this is what we look like right here. Now that we're entered in, what do we do when the market comes down? Well, as the market comes down, essentially if the price hits the edge of our tent here, then we're going to exit this upper butterfly. And also a note that I'd like to talk about here is this is when I normally like to exit the trade, when the marble is on top of the hill and I'm anywhere near profit target. So if I was live trading this, I'd be out of this. this trade did not, if you remember right, this trade did not go well. We put the trade on, we had a bearish bias, it went up 20 points, which is normal when you have a bearish bias because you don't always hit the very top of the market. I added my second third, that was great. Then it went up another 20 points. That's a little not normal, right? But I added my second third. Then it went up another 10 points. Right now, I'm saying, yeah, well, a 50-point move against you is fairly large. So we did the roll, and then here we are. So this trade is one that I would say did not go well. The market, luckily, you can say, or finally did what it should do and it backed down. We're at the top of the hill, which happens to be the most dangerous place you can be in one of these income trades. A lot of people, they strive to keep in this position. Very difficult to do that. So this is where I usually like to exit those trades. However, we're going to stay in because, well, it's good for the example. So we go to July 17th, the market continues down. I hit my lower break even. That being the case, not my lower break even, but the lower part of my expiration graph. That being the case, I'm going to just exit this upper butterfly. So I'm going to come in here. I'm going to sell off my 1190 butterflies. I'm going back into a 2/3 of a position. If the price continues to drop to the tent edge again, this upper butterfly is going to be removed. If the price continued down to the remaining butterfly break even, we're just going to close the position because we got whipsawed out of the trade. That happens sometimes. It happens fairly seldom. Even if it does happen, in this particular case, we should be able to at least break even or not lose money. Also, on the flip side, if the market goes up, I would consider exiting the trade at this point because we got double whipsawed, right? So in other words, the market went up, we followed the trade up. The market came back down to the point where we actually had to make an adjustment and remove the upper butterfly. If the market comes back up again to the point where I'm in trouble on the upside, which in this case for me would be 1175, if that's the case, that's something that I don't have written in the presentation, but it's something that I use as a general guideline with most of my trades, is the 3 strikes and you're out rule. I had to adjust up, I had to adjust down. If I have to adjust up again, the market's too choppy, I'm out. And that's the end of the trade. So that's a very good, I found that as a very good rule in general to follow. So, and especially in this case here, where I would only be 8 days till the end of the trade, I'm definitely considering, exiting this thing with what I can get. And like I said, the trade has not been going particularly well. So, in this case, the market didn't really go anywhere until 21 days to expiration, and this is our exit date. I happen to be $1,500 gain, which is my profit target. So by both criteria, I would exit. But realistically, I would have exited earlier if I had my profit target, and I would have exited anyway, even if I wasn't at my profit target or even if I was down money. I would exit this at 21 days to expiration and call it a day and move on to the next month. So what I would like to do is I'd like to go into option view and take a look at charts on Thinkorswim as well and look at some entry triggers, make a couple decisions, go through a few sample trades, and go from there. One other thing I would like to mention too, again, it's not in the written rule summary, I might add it into the slide a little bit later, is that if this trade were to lose to the upside, in other words, I get into this position here. The market continues, I have to make another roll. The market continues, I have to make another roll. I hit my maximum loss number. At that point, I'm going to, at 21 days to expiration, or if I hit my maximum loss number, I'm simply going to roll it out into another month. I'm going to continue to trade this. If I had a bearish bias, the market went up so much that max lost me out. In other words, in order for me to enter this in the first place, the market was overextended. So I entered the trade. The market kept going to the point where this max lost out, which was a pretty big move, especially when the market's overextended. That puts the following month at an extreme high probability entry for me, and I'm going to do it. Now, the charting may or may not be up well, I suppose at that point the charting would theoretically be up even more than 60 points or more than 80 points or 10% in the last 60 days. But if for some reason it wasn't, then that's an extremely good entry and I would enter the next month anyway. So if I have an ongoing campaign, I would just continue on with this campaign and go because the market's going to back down at some point. And so I suppose I guess that wouldn't have to be written in the rules at that point. But that's because obviously the market would still be 60 points over the low as far as I would think. In the event it's not though, I mean just kind of keep that in mind. If you ever lose one of these, the following month is a very, very high probability that things are going to go well. Nothing's ever for sure, but that's based on my experience. Those are some of my best months is when that happens. You just want to make sure you select the proper strikes. So let's go back and we'll go into option view. We'll do some examples here. So what I did is I took a look at the chart 2 years back, and we're going to take a look at when we have our how many entry points we would have hit. So this is March of 2013, right? We'll assume there's no entry here. Here we have a low of about 900. So we'd have an entry point of around 980, which happens to be right here. So that would be an entry point. And let's just record the date here. That's March. So we'd have a May 15th entry point. We'd have another one here at 940 plus 80 is 520 as 1020. So we'd have another entry point here. We have a low here of 1010. That puts us at 1090. We never actually had an entry point there. Here's, well, let's maybe we did. So let's 60 days is going to be 10. Let's take a 60-day low. If we go from this high here, go September 8th. Nope. If we come here to October 1 and we go to August 1, no. So this one didn't hit one. Here we have 1040 plus 80 is going to be about 1120. So we would have just barely tagged on to one here. So we'll have a month there. But that's basically how you do it. You go boom, boom, boom. These here may or may not have hit. Let's see, 60 days from here, November 11th is going to be January 11th. So November 11th, we were at about 1100. So at about 1180, anything over 1180, we would have an entry here, which would be, technically we'd miss that. We would hit, we'd miss, we might hit this one, but I would say no. Our next entry at this point would be here. So you can see that you have sporadic months where you can trade this. We had 1 month here, we had another month here. We missed out on a lot of this. We're going to have another month here. We're going to have another month out here. So there's going to be times when you're not going to meet your entry criteria. That's okay. This is a bearish opportunistic trade. The rest of the time, if you're still trading the bull, you're still doing perfectly fine in this whole environment. There's really not much of an issue here. So a good combination of trades to do together, which we'll kind of talk about in a little bit. So those are my entry points. So we'll just take our first entry point here, which like I said, if I estimate this to be at 900, when the market hits up at the 980 area, and we'll call it this day here, we'll take the date of 5/14, 2013. So 5/14, 2013. Let's take a look at our option view. If we look here, we have our option view on 5/14/2013. We have June is 38 days to expiration, July is 66, August is 94. I'd go with the 66 days to expiration. We're at 983, between 20 and 30 points under that is 960. So I come to my 960, which is here. I can sell 2. I buy my wings. Again, in Thinkorswim, this is just a regular butterfly order. I take a look at my analyze graph. This is the position we would be entering here. So I go ahead and close that. I convert that and buy the position. Notice I only have, I remember I have a $5,000 planned capital. I only have maybe $1,100, $1,200 in this thing, and I'm looking for a $1,500 profit target. Hard to hit if we're only 1/3 entered. So in other words, if the market kind of comes back and swings around in this range area here, I may never hit my $1,500 profit target, but I am doing it with only $1,200, so you have to keep that in mind. It still will be a good trade if we do that. It just may not hit the actual profit target number. We'll probably exit 21 days to expiration before we get to that number. So I would like to get 2/3 scaled in. We'll see how this goes. So I can come and look at my charts. I know my add point at this point. In other words, I don't do anything in this trade unless the market is down to 910 or the market is up to 40 points over this, which is my first add point, a 1,000. So if I just come in from a back trading standpoint, I just come and I look at my charts. The market goes to 1,000. It doesn't really even ever hit 1,000, does it? So let's kind of take a look. So let's take a look at this. We're just going to bring this all the way to 521. So we'll go back to option view. We know we don't run into any real trouble. 521, we're at 1,000. This is what our position looks like here. We're not quite at 1,000, right? So this is what I was talking about before. Normally, I'm not waiting for every second to hit this 1,000. Now, could I enter my second third in here, particularly if I was bearish? Yes. If I was bearish and I wanted to get my second third in, because now I'm even more convinced the market's coming down, in that case, I might add it early. But from a trade plan standpoint, I'm usually not going to do that, so we're not going to do that here. If we come back a few more days, this is one of those cases where we would have been better off just to add the second third. But that's okay, because sometimes you're going to do that, sometimes you're not. 994. So we're just moving this forward, moving along, and as of right now, we're 43 days to expiration. We did back inside the tent a little bit. We're not up anything to be too excited about here. We'll just periodically check some things. We're up $58. Here is what our position looks like at this point. If we had added that second third, if we had the opportunity or the market went up enough to get us into that second third, then that would have been fantastic, and we'd be doing much better now, which is why we like to get 2/3 in. And if we go down to 21 days to expiration on this, we are up about $500, which is about 1/3 of our profit target, or 10% of our planned capital. Or if you take a look at your actual invested capital, you're up almost 50% of your invested capital. So this is a case where we got in, we didn't quite hit our add point. Again, possibility if the market went a little higher, or depending on the time of day you checked, you may or may not have added it. Again, I'm usually not in a hurry, so if I was live trading this, I probably wouldn't have added the add point. The market did pull back for us, or it didn't go any higher. Essentially, it's the same. This is the exact same price that we entered, right? About 21 points under the market. So really, we didn't get the pullback that we wanted, but still, we made a 10% profit on this trade. Now, this would have worked out if you probably weren't a bear vertical. It may or may not have. You would have come close to tagging your maximum loss when we pushed up those 20 points. Would you have made more than 10% in a bear vertical? Probably not. So, very good trade from a capital standpoint. And plus, like I said, I only had $1,200 on the market, or less than $1,200 in the market. So really, really good risk return there. So let's take a look at another one of these. So I'm 21 days to expiration. This is what we look like on the analyzed graph. We would go ahead and exit this. Of course, had the market come down to this level, you can see that we're looking at 100% trade on our invested capital and a little bit less than a 30% on our planned capital. So that's essentially how that particular one worked. Let's look at one that may be a little more difficult here. So let's see. Let's take a look at. We'll take a look at this month for July. Let's see. We had a low here of about 940. So at about 1020, we would be entering the market, which would be this day. Again, this is not quite. This day here is not quite 80 points because we have a low of 951. We have a close up here, assuming we use the closing price of 1020. So that's only actually 70 points. That's not quite high enough. We would go, and I probably wouldn't go with that. Let's just go with that though, because it's going to make this a more difficult trade. So let's go with this date here. Again, realizing that I wouldn't enter this date, I would go the following day because we're not quite to our criteria yet. But I just want to make this a little bit more challenging. So let's take a look-see here. This date is July 10th, 2013. So let's go into here. Let's close this trade. And we're just going to mark this off so it doesn't get mixed in with our other trade. Let's go to July 10th. And here we are, July 10th. We hit our trigger point. We have a choice of going in 37 days to expiration or 72 days to expiration. I'm going to push towards the 72. If we go to between 20 or 30 points below the market, we would be with our short strikes at 1,000. So let's come in here. We'll add our butterfly to. You can see here at this point, our cost for that is just slightly over $1,000. Again, we're looking for a $1,500 profit target, despite we only have $1,000 on the market at this particular point. So we'll come in here. We started at 1,000. That makes our add points nice and easy. They're 1,040, 1,060, and then we have a roll point at 1,070. So let's move forward to those points. This should hit the first roll point relatively quickly because the market just gapped up. So at 1,020, we've actually exceeded that number on the very first day. So let's go here because of our entry time. So we'll go one day. Oh no, 1,040 is our add point. So we didn't hit that the first day. So that's the first day. There we are. So here we are, 1,042. We've exceeded our first add point. We're going to come in here and sell, go 20 points higher than our 1,000. We're going to sell the 1,020 puts. We will add our longs. This is what our new position is going to be like. So I'm going to go ahead and convert those trades. Obviously, again, this is what I like. I come in 2/3. Now, if the market backs off over the next certain period of time, then I can make my money fairly quickly. So let's kind of convert those trades. I don't believe that actually happened in this circumstance, but let's take a look. Okay, we backed down a little bit. Let's see, let's look at the charts and see when we went to 1,060. All right, so technically we didn't hit 1,060 until out in here somewhere, which is going to be around 8.2. So let's go to, let's do that. We'll do a check here at July 29th. Right, so far the trade's going fine. The market's been up quite a bit. Take a look at 8.1. We're 1,058. We're drawing down a little bit. 1,059. Maybe we may, again, this might be a situation where we don't quite hit our number. No, 1,061. There we are. So we're down around $376. Not a concern. So let me do -2. We'll add in our last third. And now our position looks like this. Essentially, when we hit 1,070, we're looking at doing a roll. At that point, we'll be down about 1/3 of our maximum loss here. So let's do a trade conversion. So again, we had a bearish bias, or the market was overextended, but the market just kept on going here. So let's. I know we never hit 1070 because we looked at the charting. Of course, that'd be different if you're doing this from day to day. But let's just go to where the pullback is. So now we're still here. We're going to run into a problem if the chart hits. In other words, so from here we essentially do nothing unless we hit our 1070, or if we hit, we'd have to be down here at 980. We'd be starting to scale back on this. I don't believe the market went that low. So here we are. Okay, so this is a good date here. So here we are, marble at the top of the hill. We've hit our profit target number, and it's time to exit the trade. So like I said, this is where a lot of people try to stay in the trade. This is where I love to exit the trade. It's where I see most of my possibility. So we'll just come in here and we would exit out. And we're just going to mark the T-log here. So what I'd like to do is to maybe just pick one more month, and then we'll kind of close things up. Let's take a look at this date. It's the 19th of August. So let me just take a look there. August 19th, where obviously we're not up 60 from the next day. So I think we did not have a really good entry point here. Let's see, what's this one? 1100. let's see, we're 1100. We have an 1180. Yeah, like I said, this would be a situation where if I know without back trading this, right, this would be a situation where I would enter the trade. Technically, I could enter it this day. Like I said, it just barely hit it. I enter the trade. If I get a pullback of about 50 points or to 1130, I'm exiting. This case here, I would have hit that pullback point and I would have exited the trade. We can take a look what that looks like. 123.14. Keeping in mind, we probably wouldn't have entered that trade, but let's take a look anyway. So if I was here at 123.14, I have a decision point of 57 days or 85 days. 85 is kind of far out. I'd probably go with the 57. I'd come in here at, let's see, we're at 1169, so I would technically go I wouldn't go with the 40s, I'd go with the 1030s. So the 1130s. So let's go with the 1130 butterflies at 57 days to expiration. No, I'm sorry, I would be in the 1140s. The 1140 butterflies here, -2. This is a case where you would actually be better off in a bearish vertical because you just happened to hit the top of the market and the pullback was fairly extensive, more than 50 points. But we don't know what that's going to be at the time. So let's take a look at this. This is our trade. When we hit 50 points under our long strike, which is down here, we exit the trade. So the price to exit is 1090. So let's just kind of convert that. Let's take a look at our charts and see when we actually hit 1090. Oh, look at that. We may not get stopped out of this trade. We may end up being stuck in it, which would be interesting. So let's take a look at that. Let's take a look at this low here, which is going to be on the 5th. So let's just move ahead to the 5th. Right? So here we're sitting in this position. We actually did not hit our exit point, which is fine. So we just barely made it in because of the because it was just barely up enough, and then we just barely missed our exit point. So that's fine. It may have tagged it intraday, but like I said, I'm not interested in intraday. Realistically, my risk here is not that bad. The market continued down. Realistically, I don't hit my maximum loss ever, so it's not a problem staying in the trade here when this pulls back like this. So that's looking good. So let's just kind of move this thing forward. From here, we had a crazy, crazy aggressive bounce, right? And this is the position we look like here. And this is one of those things, this is one of those situations where we say we entered the trade with a bearish bias because the market was up so much, but now the market's retraced 50 points. we no longer have a bearish bias. Therefore, on the way back up, if I'm almost stopped out of my butterfly, that means I've had, in this case, a 70-point pullback because I went in 20 points under the market. I went almost 50 points under my short strike. That's a 70-point pullback, right? That being the case, I'm no longer bearish. So realistically, I would want to exit now when the market, or actually maybe even the day before. From a practical standpoint, I'd want to exit now. Again, marble on top of the hill. I'm not near my profit target, but I am in a unique situation here. However, we'll just kind of play this out because this is probably going to end up being a trade that was a losing trade. But let's move forward here till we get to 21 days to expiration. So with 31 days to expiration, we have an add point of 1180. Let's look at 1180 in our toss charts here. We are here. 1180 doesn't happen until looks like this day here, which is the 25th. So let's just pop up to the 25th. Right, you have plenty of time to see this going bad on you. Right, plenty of time here. All right, so now we're the 25th. Oh, we're not at 1180 yet. Let's try the following day. No, we're still not at 1180. I think we had a few bad days of data in Thinkorswim. But essentially, this would be our exit day right here. So we're 21 days to expiration. We would exit because we are 21 days to expiration, and this happened to be a break-even trade. At this point, we are up 80 points from the bottom. We could just go into the next month. Now, let me take a look at that and mark this in the T-log. Right, I know I'm up 80 points at this point. I can go into the next month. Do I want to go into April or do I want to go into May? I want to buy myself time. I want to go into May. I'm at 1183. I would enter at 1160. Right, minus 2. 1, 2, 3, 4, 5, plus 1, plus 1. Let's convert this. We have add points now at 1220. So let's see where 1220 is. 1220 is never tagged. So let's just run the trade. So we'll go to the point where we'll just check a couple days in. Right, I want to give myself time to be right, which is why we went in that strike level. 520. Let's just go to. So here we're standing now. It's March 27th. March 27th. Let's just go to the bottom of this, which was April 14th, if we don't run out of time. So let's just push to April 14th. All right, so we're just sitting here for like forever. We actually hit our exit point. So here we are. We are 50 points below our short strike at 1110. We're still 32 days to expiration. It is time to exit. So we come in here, and this is a 10% trade. There's nothing wrong with a 10% trade. So let's just close this out. So essentially that is how the bearish butterfly works. Let's just quickly pop back to our slideshow, do a quick review of the rules. The trade that I've shown you had a planned capital of $5,000. Of course, you can do this any size that is appropriate for you. We had a profit target of 30% or of our planned capital, or $1,500 per butterfly. The Russell has to be up 10% or 80 points in the last 60 days, and that's whichever is less. I'm going to enter usually 75 to 45 days to expiration, leaning towards the further, giving myself more time. With a third of my butterflies as 50-point wings. The trades entered with the short strikes 20 to 30 points below the market price. The trades scaled into as per the scale-in guidelines that I showed you. The trade is scaled down when the trade hits the lower edge of the tent. The trade is exited at max loss, 40 points, that's 50 points below the short strikes of the lowest butterfly. Profit target of $1,500 or 30% of planned capital. It's exited 21 days to expiration. Or if the marble's at the peak of the hill and I'm near my profit target, I'm also going to exit. There are no volatility limits to this strategy. However, after extreme down moves such as 2008 and 2010, expect the market to bounce more than normal and allow for a larger overextension, such as the 15% rise or the 120 points. So in certain situations where we've had where we had market crashes, that bounce might go a little bit higher than expected, so you might want to let it ride a little bit higher than expected. But in general, this performs very well in both low and high volatility environments, as long as you're waiting till the market's overextended in order to enter. And that is it for the bearish butterfly, or the super simple bearish butterfly. In session 3, we're going to talk the bull versus the bear, and we're going to combine that with simple charting, which is essentially the bull trade, and I'm going to show you how to combine that with the bear trade to make something that reacts like a condor, only it's a little bit safer. So we'll see you in session 3.